All right, welcome in. So today we're going to talk about GameStop. This is kind of by popular demand. It's going to be real quick, tell you the basics of what you need to know about what happened. All right, so basically involves two components, common stock and selling short. Common stock, of course, is the equity within the company. If you think the company's going to do well, you buy the stock and watch it go up. It basically represents the company. Then you've got selling short. With a few small exceptions, selling short is the opposite of buying the common stock. There might be interest, there might be dividend payments, and it's a little bit more precarious than buying the common stock, which we'll get into in a second, but effectively it's betting on the stock going down. Okay, so a little bit about selling short. Basically, like I said, it's the opposite of buying the stock, you're selling the stock. So in selling short, you borrow the stock from a broker-dealer. Broker-dealer is going to be like a TD Ameritrade or Robinhood. They go out, they get the stock from someone who owns it, you borrow it, you sell it at that point, you pocket the money at the price, so you're betting that it'll go down, and then when you complete the transaction, you'll be able to buy it back at a lower price. So you borrow the stock from the broker-dealer, you sell it, you pocket the money, but at this point, the stock is borrowed and it's sold, but it's not owned, and so the transaction is not complete. To complete the transaction, the stock must be bought. Now, the idea of the short seller is that they're going to borrow it at this higher price, borrow and sell at this higher price, and then when it's a lower price, they'll buy it back. At some point, they do have to buy it back. Let's talk a little bit about the additional risks associated with short selling. Okay, so as I mentioned, it's very close to just being the opposite of purchasing the common stock, but there's a couple little differences. So you've got the float, which is the total amount of tradable stock out there, versus the amount that is short, the percentage of this float that's short. Now, in many cases, almost at all times, a stock that's shortable will have stock sold short. The percent of float that is sold short on a stock usually ranges from 0.5% to maybe 12%, 15%. That would be pretty high. Every once in a while, it gets up above 50%, which puts you in a very precarious position. If it's a lower percentage of the total float that is short, it makes it a little bit less risky for those short sellers. If there's a large percentage of the float, if something were to happen and the price were to move against you, it can be harder to unwind that position because there's just fewer shares out there, sort of less liquidity, and sort of less ability to unwind that transaction, at any given price. And it'll move a lot quicker against a short seller if that short percentage is a much higher percentage of the overall float. There's risk of being bought back in. So if this percent short is really high on the float and some of the shares leave that broker-dealer, the broker-dealer basically is within their rights to unwind that transaction and buy you back in at that current price, whatever it is at that moment. And that's called being bought back in. So there is that risk. And then additionally, if you do unwind it and if you are bought back in or if it moves against you and you have to be bought back in, and again, since you're borrowing the stock, there's a percentage of equity you have to have. So if you borrow the stock and it really, really moves against you, that broker-dealer is going to unwind that transaction for you and buy you back in and make you a buyer at whatever price that transaction is unwound at. So again, if in that unwinding of the transaction, no matter what price that it's unwound, that short seller is now a buyer, because they've got to buy that stock to unwind. That's how the transaction finishes. So if the stock price really moves against you and there's a question of whether your account will actually be able to unwind the transaction, i.e. that equity in the account goes away, that broker-dealer will buy you back in and unwind that transaction for you and force you to be a buyer. And as that starts happening to the various short sellers, it's going to drive the price up much quicker because now all these short sellers become buyers and it forces that price up even more. That idea of all these short sellers becoming buyers or a very large short seller becoming a buyer as the price moves against them, that brings us to GameStop. Okay, so now GameStop specifically. We mentioned those levels of float versus shorting. GameStop actually touched points of having 136% of their float shorted against, and many times was up over 68%, which is extremely, extremely high. And again, that makes the stocks very susceptible to a short squeeze, which is where the price moves against the short sellers. There's a high percentage of short sellers versus the float. So as that price moves away, all of these huge amounts of short sellers have to start unwinding their position. They become buyers of the stock to unwind the position. As they become buyers of the stock, it drives that price up even more. And that's called the short squeeze. So as the short sellers start having to unwind their positions, or the broker dealers force them to unwind their positions because the equity in the account moves too low, they become buyers. And as they become buyers, they're basically these buy orders, and they drive the price up even more. Then that price driving up even more forces more short sellers to have to unwind the positions, which drives it up even more. And that's the short squeeze. And that's what happened in this case. So let's talk specifically about the players in this instance, which is driving a lot of this talk in public debate. It's kind of a classic David versus Goliath. The hedge funds, the big multi-billion-dollar hedge funds, and a group of retail investors. So you've got the hedge funds. They were short. They were basically representing the short side. I'm sure there were other players around, but the vast percentage of the shorts was from hedge funds, and from one hedge fund specifically, a $13 billion hedge fund. And again, they were involved in this extremely high levels of short versus the float. Most likely being out here at this level, they were hoping that they could push the stock down and sort of make it a self-fulfilling prophecy and slowly unwind the position. The problem, though, is that in this case, a group of retail investors, which individually would normally not be able to sway the stock the way a hedge fund could, they band together on a Reddit message board, Wall Street Bets, I believe it was called, and decided as a group to purchase GameStop basically with market orders through their broker dealers like Robinhood and TD Ameritrade and those kinds of things, and drove the price up. Again, forcing these hedge funds to unwind as the equity went down, driving the price up. Then as the price goes up, they have to unwind more of it. Price goes up even more as they become buyers, as we mentioned previously, with the short squeeze. And that's what happened. Now, again, what's driven this to sort of new heights and into new areas of discussion is that this hedge fund was effectively bailed out by two other large hedge funds, Point72, which is actually not technically a hedge fund. It's a family office. That's Steve Cohen's family office. Steve Cohen was formerly of SAC Capital Management. There's a lot of insider trading at SAC Capital Management, so he's not allowed to sort of run a hedge fund, but he can run a family office, which is managing his own money, which is something like $10 billion. So he put in $1 billion and a half into the hedge fund that was affected mostly by this, and so did Citadel. Ken Griffin's hedge fund put in money as well to make about a $2.6 billion bailout to this hedge fund, while simultaneously Robinhood, which is kind of an ironic name in this instance, which is a broker-dealer kind of for the masses, actually removed the buy button for GameStop. So you could only sell it, you couldn't buy it. This hedge fund gets a kind of a bailout in some sense, although it's not quite that simple because those, and I don't know the details, but Steve Cohen and Ken Griffin may have had investments in the hedge fund, and based on the way it's structured, it may have been to their benefit to bail him out to some degree. Of course, more and more talk about, Janet Yellen getting, $800,000 to do a Zoom speech, and I think it's just sparked this whole conversation. But that's the basics of what happened. Is from a technical perspective, it's basically a short position versus a long position. And then from a player's perspective, it's basically a large hedge fund against a group of retail investors. And now we have a national debate, maybe for the best, but it's very interesting, and that's kind of the basics. So hope you enjoy. Hope that helps. Thank you.